Hi everyone, my name is Michael Frazis and today I'm going to update on our fund. There's obviously been a pretty severe sell-off across life sciences and the growth space, which for our sectors kind of started early last year, but it's really kind of accelerated since November and even into the last few weeks. So today I'll go through some of our stocks, show you what we're seeing, how we're thinking about things at the moment, and also what we think might happen next, how things could play out throughout the rest of the year. So in many ways, this has been one of the largest sell-offs, in the last few decades in technology, certainly in terms of the moves in large companies, so over $100 billion, $50 billion, excluding maybe the $1 trillion companies. Many of these businesses are down 75, 80%. Companies that you would know as well, like Shopify, PayPal, Spotify, there's been huge drawdowns across the board. And it's also coincided with one of the most severe bear markets in the life sciences. Life sciences had a pretty good run up to early last year and then has sold all the way back down to the COVID lows, which is resulting in pretty hairy drawdown across the board. That's kind of accelerated from early April. So many companies have traded close to cash, or certainly down to the point where 25 to 50% of their market cap is cash. I'm talking about good, high quality growth companies here. Obviously, something like 20% of the life sciences sector, or certainly the biotech sector, has traded down to cash, which really gives you a sense of the extremeness of the movements. It's like the discount rate is, 50, 100%. It's like the future isn't going to happen for these companies. Of course, the future will happen for these companies because they're very well funded, mostly cash positive as well in the growth space, cash flow positive. But the way the market is pricing these things at the moment, they've just come all the way back down. Interestingly, organic growth rates across our portfolio have been pretty strong. We're kind of most of the way through a reporting season now, and the median or the weighted average across our portfolio is well over 80%. And this is over a period where, there's been huge drawdowns across the board. So the growth has held up. The businesses are kind of doing okay. And even the ones that have reported weekly generally have reported 20 or 30% growth numbers on top of 100% plus growth numbers last year. So they haven't even kind of shrunk. They've just kind of grown less on a very high base. And in fact, what we think will happen in sectors like e-commerce, there's data statistics that's already happening, is that once we move on from the tough comparables of this time last year, these companies will return to trendline growth, which for many of these companies was 40, 50, 60%. In terms of, we get asked, what could turn things around, there's a chance that rates actually peaked recently. So they're rallying all the way up to above 3 and have kind of come off a bit. I think that probably needs to happen. Potentially a peak in inflation as well. So last week there was an inflation number came out. The month before was 8.5. This one was 8.3, which was higher than what was expected. So it did cause another little shock to the market. But you can see that is coming down. Key components like autos, durables, metals, commodity prices, excluding energy, have most definitely come down. And, this inflation really started this time last year, or maybe a month ago, a year and a month. So the longer this goes, the harder it will be for those numbers to keep going up. There will be a natural fade down. A key part of this is obviously the energy prices. So those have kind of spiraled out of control with the Ukrainian war. And any stability there or resolution there would definitely be a positive. It would return kind of energy prices to normal market equilibria rather than having, a major supplier taken offline arbitrarily, with a lot of uncertainty over how that will play out. Another thing we noticed last week was there really was seller exhaustion. I mean, there were huge moves. To give an example that you'll be aware of, Shopify traded down from almost $1,900 to roughly $500. I think we bought back in around $600. It rallied to $800. So you're talking about $900, $500, $800, then all the way down to $300 in the last 5 or 6 weeks. So a huge kind of capitulation sell down, and that clearly has reversed and is back up to $400 now. So, and that's actually, if I look at our kind of universe, a lot of companies dropped 40 to 50% to mid last week, and then there was a huge dip and then very high volume reversal, and that followed through to Friday where pretty much everything was up, 8 to 15%, in some cases 20 to 30%. So it's very similar to what we saw at the lows in COVID, similar to what we saw in the lows in 2018. And interestingly, many of these companies actually hit the lows that they hit around COVID, which was a huge panic. And it's much more extreme in this case because these companies are 3-4 times the size they were a couple of years ago. So to see them hit those levels was probably something, I definitely wasn't expecting that, but it does give a measure of the extremity of the movement of the sentiment in the sector at the moment. I got asked about kind of mistakes we made. Look, we made a few. I mean, this time last year, things were still ripping. They'd come off. I think February was the peak for us. We definitely should have been better at cashing winners. And I think with such a focused strategy, we probably do need to have shorts in the portfolio. I think now is not the time. The perfect kind of shorts were selling things like Rivian, $100 billion company with no real volume and spending a huge amount of cash against like a Tesla stock. That pair trade would have worked beautifully. Similarly in the life sciences, the amount of companies that we passed on that have dropped 90, 95 or 95% is pretty extraordinary. And I think given that most small drugs fail at some point in their life, I think it's pretty target-rich environment for shorting. Now, at the moment, we're not going to do it because I think this is like most definitely the wrong time to do it. It was the best shorting environment ever over the last, probably of a lifetime over the last kind of year. I think even in the previous bear markets of the last 20 years, they're generally pretty sharp counter-trend rallies, which for many of these stocks just didn't happen. They just kind of went down in a straight line. But now it's kind of different. So if you think even on Friday's price action, a lot of the stuff that you would short that probably is going to continue down to zero was up 10, 20%. So the last thing you want to do is build a short book at a time like that. But it's certainly a lesson for us, because we're so focused on these sectors. If there's a once a decade bear market in growth, especially small and mid cap growth, and once in a 20-year bear market in life sciences, it's pretty hard for us not to get hit without those extra tools in the toolbox. Just something we're thinking about. I think also this was a pretty tough environment. You had a tough inflationary environment already with like huge spending in 2021, long after there was a pretty decent recovery. In many ways, I think they'll go down as a huge political mistake, both on the monetary side from the Fed in the US and also on the fiscal side when the government was just handing out cash still. The effect was compounded for the tech sector because firstly, everybody spent a lot of money on e-commerce and anything online, like advertising, things like that all boomed. And secondly, because it was a pandemic, everyone was at home much more than usual, so time spent in front of a screen was maximized, which affected everything from the amount of chips and computers that were sold to advertising models to, social media platforms and so on. Look, I think for us, we need to take the right lessons from this. It's very easy to take the wrong lessons. One thing that could happen is, I'm just trying to think of some analogies. So about 5 years ago, there was a huge blow up in the energy and commodity sector. It was very tough and actually it continued for a number of years, and kind of the low for energy was actually in 2020, long after the peak, many years after the peak. Funds that mismanaged that or just couldn't make it through didn't survive. The ones that did ended up being the best performers, a few years later, and really the best performers, make everything back and more. There's a good chance that's kind of what happens with growth. Like right now, it's the space, what was once the sexiest, like coolest space has now become, toxic for institutional investors. You can't really admit that you own something like a Shopify. It's gone all the way, so extreme. And then those companies trade all the way to the point where, cash makes up a significant part of their balance sheets. And they're still posting good numbers. These companies will come back. Technology is not going anywhere. The internet is not going anywhere. And they're the sectors that have been particularly hard hit. Similarly, life sciences companies will do exceptionally well over the next 5 to 10 years as well. So I think it's going to be tough for growth managers at the moment. We're hearing some pretty interesting stories, funds with tens of billions of dollars in very similar positions to us in terms of what they're investing in, but then leave it up and borrowed to invest in private investments, which was great because everybody just wrote those rounds up for years in a row. But now it's pretty clear with like leading tech companies down 75 to 80%, those private books need to be marked down. And they don't need to be marked down 20 or 30%, which is what you're starting to see a little of. They really need to be marked down 60, 70, 80% or even more based on public comps, given that they're less mature companies. And that's causing waves of margin calls in the industry as well. Just seeing companies, and these, in a $10 billion company can't really withstand, $800 million of selling from one fund. That's just going to completely push it down. And I'm pretty sure, I feel like that's what we saw. I certainly heard rumors that was happening over the last kind of few weeks. It kind of fits with the timing, of if you think this really started in earnest kind of in November, and kind of 6 months after that, you start to see the impact as people start to realize that things aren't just going to bounce back immediately. But interestingly, those kinds of moves generally create lows. When you get these forced selling, capitulation selling, stocks just probe these deep, deep, deep lows. And once they hit that low, once that price sensitive selling stops, they can rebound on often very rapidly. And we did see that. One stock we were following for some time went from $120 down to $20 and then plunged to $15, and like half the market cap was cash. So you're talking about like 90% drawdowns here. It was up 30% on Friday, and this company has hundreds of millions of dollars of cash. It's not going anywhere. It's improving margins. It's not losing that much money. And in fact, it's investing and growing organically at over 50%. And so when you see moves like that, you can really see the pressure in the market. And even though it's been like really tough for those of us in the space who kind of took a long-term view, which is the right thing to do almost all the time, other than in these extended bear markets. And even then, it still works out just over a longer period of time. But when we've had to kind of be on the other side of that kind of selling, it's been pretty gnarly for the portfolio. But the silver lining is those things are basically trading exceptionally cheap, and they don't just bounce 20, 30, 40% off the bottom of that. They can often do that in a day. And, in similar instances where there was panic, institutional capitulation, selling, these companies went up 3, 4, 5 times, and even more in pretty short order. So we're quietly confident, though there's no guarantees, that when this does subside, and this could be a longer term sell-off as well, when this does subside, these things will normalize. They won't go back anywhere near where they were, but for us to regain our new heights, they just need to compound growth for 1 or 2 years and move back to a 10-year average of where they were. If you think about those factors that are causing so much trouble today, they will all be resolved. Or we certainly think they'll all be resolved. So Shanghai is likely to come out of lockdown this week. They've just announced. They're going to start opening up again. The Ukrainian war will probably be resolved at some point in the next year or so. And there's even an energy supply response. So the Europeans, the Americans are taking energy much more seriously, and are really kind of deeply rethinking ESG and supply and whether it is good to actually pump more energy when so many people benefit from it. I'll just share some charts. So this is the biotech index. It's gone from about 175 down to 60. I think it bonded at 62. So 65% drawdown. It's considered poor form to kind of guess where things kind of bottom out, but I just share this chart as to why it looks like it. Firstly, the extent is significant. A huge number of these companies are trading below cash. So 20% is roughly the cutoff now. Obviously, a lot of them are trading well below cash. So the entire IP, the development assets, are being valued at nothing. And you can see in the last 6 weeks, which was not much fun for most of the investment world, it's gone from 95 to 60. So it's lost a third of its value in short order. And then last week, there was a huge capitulation sell down, and then a massive reversal on significant volume. So I'll put this up on a podcast. So I'll just explain what's on the chart for people who can't see. But you can see there's like a huge capitulation low, and then on high volume. And it's very similar to what you saw in March 2020 and also in December 18, like recent lows. The biotech index went all the way back to where it was in 2014. So you're talking about like 7-8 years of returns kind of wiped from where we were just in the index. ARK, I talk about ARK because it's like an easy listed thing for people to track. And even though we had surprisingly little overlap with them in terms of stocks, we have seemed to kind of pace them surprisingly closely. I think last time I checked, we've generally been ahead of them, but we have moved in similar ways. And again, you can see, it went from 160 down all the way down to 43. And last week, there was a huge capitulation down. It went from, say, 75 to 35. So it halved in 6 weeks. So it'd already been under pressure for a year and 3 months, and then halved in 6 weeks. And then there was huge volume and a huge reversal, which again is what you've seen in prior lows. And that's pretty typical across the market as well, when you do have capitulation lows. It's kind of different if you've got a long, slow bear market that kind of fades out, puts in a bottom and goes up. But certainly in 2018, in 2016, in these kind of, and when there's like a capitulation panic where institutionals are just hitting the sell button, retail as well, that's where you get these huge dips and then recoveries. And often, a lot of selling in this market, it's kind of who owns what and who has to sell out at what price. That's kind of been seems to be driving things more than anything else. Companies are beating and dropping 20, 30%. Companies are missing and dropping more, or actually doing okay. It really seems to be what the group of growth funds that own similar stocks, what did they own? What did they have to hose? And it really feels like that was a capitulation low when things just halve in 6 weeks like that. And then you get such a strong reversal. But that remains to be seen. It's currently the 15th of May. There's been a collapse in software multiples, so they're down about 75% in the last 6 months. They've gone from like 20 times to 5 times. Even that's kind of skewed because there's still maybe 10, 12 companies that are pretty high. If you strip out the ones that have went up from 100 times to 50 times to 25 times and now trading at 15 times, if you exclude those that are still richer than the most, software is back down, at kind of 10-year lows. Yeah, it definitely traded lower in the financial crisis, and they kind of bottomed out 2, 3, 4 times, sometimes higher in the tech crash 20 years ago. So I'm not saying there's not further downside, but even if prices stay where they are, we're going to hit those multiples just because these companies are still growing and actually reporting pretty well. Most software is reporting pretty well. I'd say that's different to e-commerce where e-commerce reporting, across the board, everybody seems to have invested based on growth that hasn't come, because obviously consumers are under a lot of pressure at the moment, and it comes down to that tough COVID comps issue where you're talking about not even COVID, early 2021 comparables issue. So those companies are reporting on tough comparables. They've invested heavily on growth. Companies like Amazon, companies like Shopify investing in fulfillment, and that extra demand they're expecting hasn't come. So they've been hit on both sides. The revenue growth is less than they normally are and way below trend. Obviously, trends are likely to resume back to where they were pre-COVID anyway, which is substantially higher than they are now. But they've also had cost blowouts. That's a very different kind of software, where software is generally done pretty well. These big companies are doing fine, and everybody that moved to the cloud, that investing in efficiency and in the right database and things like that is very much on track. They were kind of some of the last companies to crack, but they really have in the last few weeks. So, Bill.com, Cloudflare, these companies all halved, were part of that long list of growth companies that halved in the last 6 weeks. Interestingly, actually, on the Amazon point, so Amazon gave the first kind of indication that there was something really going wrong in inflation, because I remember they were hiring and all teachers were quitting their jobs and becoming Amazon employees because they're getting paid more. They lifted raises, and I think they employ millions of people in the US, so they moved the needle on statistics as well. So they've done a hiring freeze and said they've hired too many people. Similarly, Facebook's on a hiring freeze. Obviously, Peloton, Netflix, a huge swathe of these companies, some of them very large companies, are now cutting back on hiring. And so you're getting the same way that they gave an early indicator that inflation was about to peak, to rip. The fact that these huge employers, obviously Amazon's the biggest by a long way, are going in the opposite direction gives an indication that wage inflation that's causing so much trouble could be 6 to 12 months away from being such an issue. And in 6 to 12 months also, you could have a resolution in the war. China will most likely be open. All those supply chain issues, the whole picture could be very different. That's obviously kind of a positive take. I'd say that even the smartest people with the most data, certainly the Federal Reserve, got that wrong. So have to be humble and open to all kinds of things happening. So yeah, cloud computing stocks have dropped 60% in the last kind of few months. The last time multiples got this low, software did 10 times over the next 5 years. So this is kind of what, we've taken a pretty big drawdown, but we are playing for upside always. And frankly, from these levels, we should do pretty well once things put in a low. And certainly the right companies will do extraordinarily well over the next 2 to 3 years, because they're all still growing. They will continue to grow. And multiples will come off these kind of 10-year lows as well, once all these terrifying things kind of ease off. It went up 10 times, but even if it went up to where we are today, where you get into like kind of inflationary, recessionary fears, GDP was negative in the first 3 months of this year in the US. It's quite likely it's negative this quarter, which means we are actually 5 months into the recession already, which is interesting. Just the way the data plays out, you generally find out after, and then it becomes really obvious in a recession, but certainly feels like it for many. Even on the prices of today, you got a fourfold return. So there's plenty to play for in the growth space. Here's some examples of companies that I'm just putting because they're kind of interesting. So Okta was like a darling. It traded all the way to 80, which is below where it was for the last 3 years. So it went below the COVID panic, and it was trading at $200, a few months ago. Peaked at just under 300, sold off to 200, and then more than half to 80. So in the beginning of April, it was over 160. It's looks like 175, and then bottomed out at 80. So you're talking about huge moves in the last few weeks. I say it's relevant because I know it's been a tough ride for everybody in our fund, a really grueling journey, to be on these drawdowns. But it's just important to see that I just want to connect what's happening in the fund with what's happening in the growth space, and also indicate the extremeness of the moves, the reversals that have taken place over the last week, and also give some comfort that these companies, they're all cashed up. Some of them have been egregious in stock-based comp. It's probably worth talking about that. Yeah, to go back to the analogy of the energy companies, so in 2015-16, there was a huge shale boom, and companies were spending a huge amount of money, like taking on debt, doing huge capex. And look at them today, after a bear market and a real tough time, the energy companies are being extremely shareholder friendly and paying back money. And if you look back, buying back shares and paying dividends. If you look at the mature companies that went through the GFC and the tech wreck, they're all doing the same thing. So Google, Microsoft, they're all very shareholder friendly, buying back shares, focusing on free cash flow yield. It's kind of like the darlings of the last 5 years. Again, I'm just using the same names that everybody knows, like the Shopify's et al., Twilios. They just spend so much. The stock-based comp blew out. I think it's something that surprised me because when I first bought these companies a few years ago, I think one of the issues I've had is I kind of bought these companies a few years right before that growth wave really took off and didn't quite appreciate that, it seems like all these huge funds in the US basically adopted the same strategy. But when a few years ago, these companies weren't paying stock-based comp anywhere near the way they were today. It wasn't like kind of 70-80% of gross profit, which is what you see. It was really one of the excesses of the environment. And I guess you could say it was like inflation in software salaries. But with Facebook and so many big hirers of engineering talent announcing layoffs and freezes, and obviously there's layoffs and hiring freezes across the kind of early stage venture-backed technology community, that's likely to ease in the future. And when these companies really rip, it'll probably be in, I don't know when it is exactly, some point in the near to mid future when the CEOs decide to actually want the share prices up, and instead of issuing more stock comp to favored employees, actually try and generate shareholder returns. I think now we're going through that disciplining process of the market that the energy funds had to deal with and the energy companies had to deal with over the last few years. Here's another one, Cloudflare, $120 down to below 60 just in the last 6 weeks. It's 130 down to say 55. This is one we're looking at. Again, you can see that high volume reversal. Kind of always wanted to be in this company because it's such high quality, but it is one of the few that remains relatively rich. But you're talking about teens EV sales now, not like 100 times EV sales. So the compression has been significant. And you can see the moves Friday, like 17% in one day. One of my big detractors was Sea. So Sea was a victim of all of these things and got a bit unlucky. So they obviously had a ban of their game in India, which didn't help. They had to reduce. They have two businesses, really profitable gaming and e-commerce. And also they went on a huge expansion in e-commerce. So entered South America, entered India, which they now exited, entered parts of Europe, some of which they've exited. And they've actually done pretty well in terms of revenue growth, but they've been spending quite a bit to get that. So this company we bought at 43, but it's one of the ones we did kind of buy at several times along the way. It went up in size about 7 times, and the share price is back, where it was 2 years ago. So it's been something like, I think on a sales basis, again, I'm just using sales because it's easy to see these things. It went from 30 times down to like 1.9 times sales. And it traded down to 25% cash last week. And we actually added more last week. We think they're probably going to report pretty weakly. We have data that suggests the year-on-year numbers are going to be tough because they've got that same e-commerce issue. But we also know in April they have re-accelerated in their core markets. So we know that growth is back on track. They're reporting this week. It remains to be seen how they'll do. But again, you can see this was trading at 140 a few weeks ago. It traded all the way down to just over 50. So there's been huge moves just in the last few weeks. And this is what we think is the capitulation kind of move and a sell down. And this is very much a stock that who owned it was very relevant. So it kind of became the anchor position for a large number of funds, growth funds and Asia funds, certainly Tiger and all of their copycats. It was something that we kind of, I feel like we bought it before that became a thing. And it's something we'll track much more closely in future. And the giveaway was probably the fact that the share price move was so explosive. But the way I was thinking about it at the time was share price was up maybe 10 times, but the company itself had increased in size by 7 times. So there was kind of some valuation excess, but at the same time, you got a company that's gone from, less than a couple $1 billion of revenue or less to, $14, $15 billion of revenue, huge gross profit. To do that, you have to invest. And ultimately, the companies that create the most value, that create these $14 billion empires in a few short years, they have to spend to do it. And we have a pretty good track record and have seen it happen many times with companies like Apple, with companies like Tesla, companies that are really doing something special, maintain that growth, and then do actually reach that point where they can slow down the growth and generate profits. We actually saw it in Pinduoduo, which we don't own. I think we sold that about $90 to $100 when we just decided to exit all of our Chinese stocks. So we did make money out of that, but we lost money in other Chinese stocks, that's for sure. But when they want to, they can just turn off the promotions. They can just turn off the promotions at any time, slow down growth, and really maximize profits and cash flow. And at the same time, these companies can also switch on advertising. And so Sea and Mercado Libre are very nascent advertising markets. And that's really what makes Alibaba, which is in a similar business, such a cash cow. So there is that cash flow destination, but Sea was on a journey of chasing that 100% growth, which they maintained for many years. And they're guiding to 75% growth in their core markets this year, but they're also targeting break even this year as well, which are almost halfway through. So they do have all these growth companies that are posting these numbers do have a lot of levers. They are spending to grow. And these companies, are under so much pressure at the moment, but in 2, 3, 4 years' time, they'll really get the benefit of that. These growth rates will compound. Even now, look at something like C, it's 75, it's still above, where we bought at 43, even in the worst possible environment, after 90% multiple contraction. But appreciate it's been a bumpy ride for us and our investors. I get asked a lot about Spotify, and I've decided to take a look at it. I was kind of a bit against it for 2 reasons. Firstly, it didn't really have that explosive growth. I felt like it kind of listed way too late in its journey at like many tens of billions of dollars. I feel like it would have been a great one to get early, but all the returns went to VC and I guess early employees. This one has gone all the way up to 360, back to 100. The thing is, one advantage we've got now is the fund's under so much pressure. There's so many good companies that are down immensely. And it's not, you don't want to anchor to these values. It's not going to go back to 350 just because it was there. But you do have these things where they've gone down to like 1-time sales. So C's 1.9 times forward, Spotify's 1.5. That you don't need to make much margin at all to make real money off that. And you're also getting to that point where the moves, maybe if you don't want to anchor at 350 and buy at 200. We've certainly made that mistake once or twice or more. But when things get all the way down to when things lose like 75, 80, 85% of their value, they trade close to cash. There's really strong upside opportunity. So I'm fully aware of the bear case here. The fact that inflation and rates, the Fed seems to actually want to destroy wealth, which is a strange thing for the central bank to want to do, given that they spent so much money trying to create wealth just literally a year ago. But when you see these charts, when you see the extent of the moves, the capitulations, the panic, the reversals, and on an absolute basis, how low these things have come, you can really see there's an opportunity. So I really think these companies like this will be worth several times more over the next few years. Even if it takes a few years to get back to all-time highs, or not even get to all-time highs. This thing could triple and still be, down 20%. It could double and still have basically been cut in half. There's it's such an opportunity-rich environment at the moment. So even though we're down a lot, we're still kind of focused on these kinds of companies and looking for new opportunities. And we don't actually own Spotify now, but it's something that I'll be focusing on this week. And here you can see the free cash flow yield and kind of multiple. So again, I think I always thought that like the COVID low was quite a big panic. All these companies have crashed way below that in terms of multiple, and many of them hit the actual COVID lows in terms of price as well. And you can see that, Spotify, it's 25% gross margin. The other issue with Spotify is that which has kept me back from the stock, is that they kind of need to have every label on. It's not a great product if there's only if 20% of the music you want to listen to isn't there. You'd think with one Spotify and all these different labels, they might have some negotiating power, but it's weak because they do need to have every single label on there. And I feel like the kind of idea of spending huge amounts of money, paying for content, paying for Joe Rogan, paying for podcast specials is just the wrong approach. It just reflects poor cash management. It's not kind of what drives, like good art is what drives engagement. I don't think you can buy that. It did worry me that they're going down that route. Another one we're looking at that we just bought, we bought some at $14 and some at $7, because along with the rest of the space, it was down 80% and then halved again over the last few weeks. It's Farfetch. Traded down to $6.80 with $3.59 at cash. They do have a bit of debt in there, but this is a company that, pre-COVID was doing 60, 70% growth. Management is committed to 30% over the next 5 years. You can see in these numbers, it's exactly what we look. They did $1 billion of revenue, but lost 121. Now, this year they'll probably do just under 3, and they'll be probably break even. So it's not generating a ton of cash now, but margins are moving very fast in the right direction, and growth is holding up. Now, it's a consumer stock. It's a luxury fashion. It may well come under pressure over the next year or so, but luxury fashion isn't going anywhere. And this is a company that's gone from $70 to $7. And so, again, aware of the bear case, but you have to appreciate that a lot has been priced in these levels. Certainly when they trade so close to cash. And then combine that with, actually, there's two things. Usually when you see drawdowns like this, like 70 to 7, it goes from 70 to 7. Usually when you see that, there's like some credit issue. A company just melts away because the equity value, the value cuts in at the debt. there's the equity value, there's the debt, there's what it's actually worth. It just kind of goes, and then the company melts away. None of these companies are really in this situation, and they've all got a ton of cash. And so they're all going to survive. They're all going to be there. I won't say all, but they will almost all be there in 2, 3, 4, 5 years, and will continue growing and be worth a lot more. And so there really has been, this most definitely was overvalued. I think we sold out, the 30s and 40s. We first bought at 17. Now it's back down here. It's pretty incredible return opportunities available at the moment in the market in these stocks. Now, a company that's investing, it's lost money, now it's break even. It's just so out of fashion now, as you can see. And if you look at like funds like D1 and others, they've got hundreds of millions of dollars in stocks like Farfetch. And again, you can't really liquidate. I'm sure these price moves have been one or more of these funds liquidating. But the upside opportunity is pretty phenomenal. And so the good and bad of our strategy is that, we have taken a pretty big draw here. We have been invested and been along the ride, both on the up and the down of some of these companies. But, a good year for us isn't 10, 15, 20%. A good year for us will be much better than that. From the lows of COVID, for example, we went up several times. I don't think we're going to get that release from the Fed again. But then again, these companies have come way down. They're way cheaper than they were in COVID. The sentiment has swung harder against them. And all these factors that are pushing things down, even a bear market or recession, are likely to be over in 1 to 2 years. So there's a lot of opportunity at the moment. And there you can see like that consistent monthly growth that we always look for in our companies, and how far that multiple has really come down. We also pulled the trigger in the last week on this high quality SaaS. So I always thought this was one of the most dangerous parts of the market. These things were trading at, I think these are projected sales, but on a historic basis, like 50 to 100 times. They've all, on a multiples basis, they've all come back down to kind of low teens, mid-teens. These are the highest quality companies like Datadog, CrowdStrike, all have just reported. They're all reporting like kind of 60% plus growth rates, organic growth rates, in a tough environment. They're all kind of mission critical and best in class. So I think it's a pretty exciting opportunity to get into these companies. Could they trade lower? Of course they could. There's no rules. These are actually profitable at the moment while still generating pretty significant growth rates. But over time from these levels, the growth rate by far becomes dominant. And we know in a normal environment, which I'll classify as any time over the last 10 years other than COVID or other than, I guess the last kind of 6 weeks, these things will happily maintain, serious value, probably at least where they are trading today, at these extreme levels. So I do expect the returns from these stocks from these levels to at least equal their growth rates from here, whilst keep being completely open to the fact that the sell-off could continue throughout the rest of the year. But the long-term returns from these levels, from the highest quality companies, I think will be exceptional. There's one like SentinelOne that's doing over 100% organic growth rate, traded down to like 8 or 9 times forward. So you're talking about that's kind of where, it's low for a company growing that fast. And there's a reason software companies like Adobe, even today, will trade at say 10 times sales, because these companies have almost all their revenue is gross profit, and they maintain very high growth rates, but they have a lot of flexibility over that. So as their markets mature, as growth slows down, they kind of change their focus and can very quickly generate free cash flow and start buying back shares. As Autodesk, Salesforce, Adobe, ServiceNow, companies like that have already done. And typically they can still grow at 20, 30% while doing that at maturity or after 15, 20 years of growth. Square's another one we just bought back into. So we thought it was smart for selling Square and Afterpay at the acquisition, but obviously we didn't quite anticipate the entire growth space would sell off like this. Again, you can see that halving in the last 6 weeks. So it went from 150 down to like 65 just in the last 6 weeks, and now getting to really interesting levels. Unlike Shopify, it didn't actually quite hit COVID lows. But this company has come a long way in the last few years. Widely loved by customers. Merchants love it. People like the Cash App. It's a great company, and I've no doubt that down, whatever it is, 290 to 75 with exceptional gross profit growth, exceptional return on investment. I do think the Afterpay acquisition will be seen as a huge mistake, and has really kind of impacted their profits, but also that has been more than wiped out from the share price as well. My guess is Jack Dorsey will deeply regret that decision to buy that company when he did. But he wasn't the only one. And actually, Carvana, which we've exited out of but are monitoring very closely was one that we basically made a decision. Anything with a credit issue, we're just going to sell, because we don't need to have credit issues at the moment when there's so many companies down 75 to 85% with huge balance sheets, so with huge piles of cash. They're still growing very fast. We don't need to take that risk. But Carvana did a $2 billion acquisition at the top of the market last year. So 6 months ago, they were riding high. They'd grown 7 times. Share price was up 10 times from when we bought it, but revenues were up almost 10 times as well. When we bought it was losing a ton of money. They had their first year of EBITDA profitability. They only had 1% market share. It was a really exciting moment for them. And they pulled the trigger on an acquisition and then had to fund that recently. Now, since then, the base rate in the US has jumped, almost 3%, maybe 2.5% for the 10-year. And credit spreads have blown out. And demand for cars slowed down. So they basically were anticipating, and they just did an acquisition that doubled their capacity. So they basically doubled their ability to recondition cars into a declining market with a pretty cooked credit situation. And they ended up raising $1 billion of equity and $3 billion of debt at 10%. So for us, I haven't actually got charts here. The reason we exited it's $3 billion at 10%. It's hundreds of millions of dollars a year that will go not to equity holders. It's definitely not over for them. A lot will depend on what happens next. And now it's a serious set of layoffs, and you're actually seeing that across the board in tech companies. This is, for a shareholder, actually what you want to see. Obviously, it's tragic for people involved, but it does show there's some level of cost discipline, but it just remains to be seen where that lands. And again, it's one thing to cut. If they didn't make the acquisition and raised equity instead, it's one thing to make huge cost cuts. It's another thing, again, to make huge cost cuts, and then the first $300 million of savings goes to debt holders. So that whole situation went from being, amazing to just deteriorating extremely rapidly. And I think since we sold, the share price has collapsed. But it's one we're tracking. We know the company very well. We know what to look for. We have very good access to data on that. If there is an opportunity in the future to get back in, we'll take it. But at the moment, I've given you a number of examples of companies that have traded down as much or even more, that don't have those credit issues, that sit on piles of cash and are still growing much faster than Carvana is. I think the market shrank by 15% and they grew 15%. So the idea that they'll continue taking market share was definitely correct, but the combination of all of that and then doing a $2 billion acquisition at the top and funding it so expensively with debt makes it pretty hard to own. And not in this environment with so many companies down as much or more, it's not a risk we needed to do. Bought a little Twistback. This is one that I think one of the challenges that I and many others had is over the last 10 years, we've been training ourselves not to sell, because, you sell something in 2016, 3 years later, it's 4 times the size in terms of fundamentals, and the share price is up 4 times. And that 5% position you sold has become extremely costly. Maybe even there was multiple expansion and it went up 8 times, and would have been 40% of your portfolio. So many of us were training ourselves not to sell. And then the flip side was that in this environment actually was, because things deteriorated with the war, inflation just kept getting worse, rates just kept going higher. This was that period where things just did deteriorate for, over a year. So this one we sold at about $100. It then ripped above 200, and it kind of sold off ever since. It went from 200 back to 34. I think we bought in the mid-20s, and then 3 years later, after many years, in 2019, 3 years later, with many years of growth, it's almost back to those levels. But again, you can see it went from 58 to kind of 24. You see it halved along with everything else. So I'm just trying to give context. A lot of these companies have actually halved from beginning of April till a few days ago, and then obviously huge rip in the last couple of days, so up 16% on Friday. And so we have bought a few more shares, but really we don't too much in these companies at the moment, just because we want to go in the highest quality possible companies that are trading at these record lows. I don't think we need to stretch too far down the risk curve at the moment, given how extreme the moves have been in the very best of companies in the growth space. Shopify is another example. We've talked about it before. It went to COVID lows, even though it's 4 times the size. 2 and 3 year revenue and gross profit CAGR is exceptional. Sadly, going through a kind of investment cycle, which is the last thing anybody wants to see, working on fulfillment. I do feel like the management seems a bit blasé about the stock price, judging by Toby's tweets. There's a real simple solution to all these companies, all these software companies that are stressing about how much they have to pay their employees, they need to reload their stock units and their stock comp. It's real simple, just like cut those expenses, show some like control over margin, and no doubt the stock market will reward them richly. But you can see this went to kind of 1700 all the way down to kind of 500, ripped to 800. We went from 800 to 300 in the last few weeks, and just kind of bottomed out. Or I don't know if it's bottomed out, but certainly went from 300 to 400 in the last couple of days, last few days. And so this is one that we added a little bit to as well. And it's been listed since 2017, and it's kind of record low multiple as well. I thought I'd share like a more mature one. So we've got kind of, as certain companies have not performed, we've closed them out, which gave us a bit of cash, which actually we held for a lot of the last 6 weeks. Though the moves were so extreme, it didn't really seem to make much of an impact on our unit price. Because a lot of companies like Adobe, Autodesk, Salesforce, they kind of didn't quite halve, but went down 45%. And I think these are kind of interesting now because the moves have been quite significant. They're at 5 or 10 year valuation lows, 4 to 5% free cash flow yields. And it's also interesting, like this is just an example of what a mature software company looks like. Last year, 23% top line, 24% bottom line, 2 to 4% free cash flow yields at 10 times sales. Salesforce is another one. So this is listed pre-GFC, I think in 2004. So the back end of probably just after they must have waited until after the kind of aftermath of the tech crash 2000. You can see it's at a low. So between 2008 and 2009, it kind of dropped. But other than that, how many years is that? Almost 20, 18 years. This is as low as it's ever traded. And again, look at that consistent revenue growth. And it's almost halved, not quite halved, but almost halved from high to low in the last kind of 6 months. So there is opportunity in these kinds of companies. We don't own Salesforce. We have added a little bit to some of the others. But Salesforce is interesting because the chart kind of really tells a story. It's not, in 2011, it was trading at twice the multiple. So people are saying, getting so much pushback at the moment. It's amazing. Like the most tech forward people I know are like, I think it's all going to zero. It's all going to zero. And, the last few years was some insane bubble that is incomparable. It's like, no, I don't think 2011 with the Euro crisis was a tech bubble. I wouldn't describe December 2018 as, exuberant moment. I wouldn't describe March 2020 as a moment of speculative excess. But all these companies are trading lower than those moments, which gives you some indication of where we are and where things might go next. Another we've added to is we avoided chip makers, but so AMD and NVIDIA have both roughly halved. AMD's got a really interesting story. It's kind of like they also ran competing with Intel for one thing, NVIDIA for GPUs. All the kind of, their suppliers want to keep them in business because they don't want either NVIDIA or Intel or any of these companies really to dominate the sector completely. And it's just been through this huge turnaround, and he's growing top line at over 60%, bottom line even more, 4% free cash flow yield, 20 times PE, all the things you might look for, both from an after-tax or free cash flow yield perspective, but also with the top line. And it's halved, or almost halved in the last kind of 6 months. So definitely think there's a value opportunity in companies like this. It's got plenty of cash, it's free cash flow positive, it's definitely going to survive. These are the kinds of companies that we're also looking at and have taken positions in. There is one concern, and these do have a cyclical component. So their end markets are basically computers and data storage. Both of those things could slow down, and particularly NVIDIA seems exposed to that kind of high-end computing. And it's still vague as to how relevant these companies are, because some of their products are used in cryptocurrency mining. That's kind of always been a bit vague as to how extensive that is. The companies basically say it's not. It's pretty clear to some degree it is. You can see NVIDIA components on the market. So there used to be a shortage of them, very difficult to get. Now you can see them, you can buy them secondhand quite easily. So these cyclical components, it's not a slam dunk, as clear a slam dunk as the valuations kind of show. Nevertheless, this is a moment where all this stuff is priced in, and these are amazing companies. They have very unique products, and there's definitely long-term investment opportunity. I think it's clear, like no matter what you think of what's going to happen next, there's no doubt over 3, 4, 5 years, these companies will do exceptionally well. So to summarize, valuations have dropped in some cases to 10-year and lifetime lows. It's a really tough drawdown for us. companies that are up 5-7 times or more in terms of size, gross profits, back to where they were, 3-4 years ago or below in many cases. Even the last 5-6 weeks, almost all the companies I showed you have dropped, or many of the companies I showed you dropped 50% in the last few weeks alone. Even while reporting generally pretty solidly, certainly growth numbers, certainly growing. They traded so low that, cash represents a significant part of their balance sheet. I think what's happening is big funds are blowing out of these positions. Institutional shifts started 6 months ago. The drawdowns have happened. Obviously, to some extent, we're kind of lucky in the sense that we don't have like a big institutional mandate that can be pulled that will force us to like just hose stocks down to zero or at any price. But these other funds do, and that's clearly been happening over the last few months. And it's also been happening because there was some speculative excess, particularly in private markets, that these big funds that focus on growth got caught up in, and in many cases leveraged to invest in those, and now forced to liquidate these things. And now you've got this moment of like peak inflation, peak war, peak supply chain, everything's going wrong. There's too many, the Fed's tightening and wants to reduce, everything's just like in the worst possible environment at the moment. And that's caused these things to be sold down to, to the point where cash is, 25 or even 50% of market cap. And in many cases, in the life sciences, certainly more than 100%. But nevertheless, the vast majority of these companies, with some exceptions, which we've sold out of, and I'd consider them mistakes when we got caught up in a credit situation, but the vast majority of our companies are not in that situation, certainly not in the portfolio now. They're not going out of business. They're all going to be around. And yeah, I think a lot of the damage is behind us. It's been extreme movements that have pushed things down, and now you're getting very sharp reversals. And it's pretty hard to find anybody that has anything even vaguely positive to say about any of these companies. So we've used the opportunity. We've had to take some pretty stiff medicine when companies have reported poorly, and we've had to trade out of them. But we've also been in the lucky situation where we can buy back into stocks that are down 75-80%. And again, the highs are not relevant. We don't want to anchor on those but what is relevant is the things that these are trading on 10-year lows and are still growing and are cash flow positive and going to make it. So yeah, even though it's been a very tough time for us, forward looking, it's one of the best opportunities we've probably seen in many years. And if things do reverse, people look back on this and probably talk about all the things that they bought, if they did or did not. But really, these opportunities don't really come along very often either. So we know that these kinds of companies that increase, these companies that grow 3, 4, 5 times in a few years, as many of these companies will do, when they get pushed down to these extreme valuation lows, close to cash, they will get that 3, 4, 5 times fundamental growth. They'll also get multiple expansion on top of that. Certainly not to the highs that we saw. That could be another 20 years before you see something like that. But certainly way above where they are now. Certainly where they're kind of priced into bankruptcy or priced relative to their cash on their balance sheet. And that will give a pretty serious return, and that would certainly get us back above, where we were a year ago. So that's kind of what we're playing for. That's kind of how we're seeing things. If you have any questions, let me know, and I'll try and do one of these once a week, even if it's just a podcast rather than video as well. So please get in touch, and I hope that was interesting and informative, and you have an excellent week.